Right now, look at the numbers. Really look at them. Gold is sitting at $5,043. Silver has crashed from $121 down to 77. And if you are like most people, you are looking at these charts and asking the wrong question. You are asking, is this a bubble? You are asking, is this a mania? You are looking at the vertical climb and thinking you missed the boat, or worse, that you are about to buy the top. But I am here to tell you that if that is what you are seeing, you are missing the single most terrifying signal the financial markets have ever flashed. Welcome back to What Changes. I'm May, and today we are not talking about a bull market. We are not talking about a stock rally. We are talking about a symptom of a sick currency system that is breaking down, first incrementally, and then, suddenly, exponentially. Listen to me carefully. The establishment banks, the mainstream media, and the corrupt institutions do not want you to understand the data I am about to show you. They actively profit from your ignorance. They want you to think this is just volatility. They want you to think this is just market noise. But the ones who understand the difference between a bull run and a bubble see something completely different happening right now. If you are new here, you probably clicked on this video with suspicion. Good. That is exactly the mindset you should have. I don't want blind followers on this channel. I want people who verify. Most of the viewers who stay with What Changes are the ones who came here skeptical, checked my sources, and realized this isn't hype. It isn't propaganda. It is simply the undeniable reality of the math. So, here is the setup. Western spot gold is holding above $5,000 after a historic weekly close. Western spot silver is at $77. To the uneducated eye, that looks high. But here is what everyone is missing. These prices aren't signaling a mania in the metals themselves. They are signaling the complete dysfunction of global currencies in general, and the US dollar in particular. This is scarier than the tech stock bubble. It is scarier than the mispriced mortgage securities of 2008. Because this isn't about a sector of the economy failing. This is about the sovereign bonds that represent the foundation of the economy failing. This is a symptom of things we have discussed for years, finally coming to fruition. And before we go any deeper, I need you to do two things. First, if you want to stay ahead of this collapse, you need to join the Telegram channel listed in the YouTube description below. That is where we can talk freely if this platform ever decides this information is too sensitive. And second, check out the book recommendations in the description. You need to arm yourself with knowledge because the time for guessing is over. Let's contextualize where we are. We have gone from an incremental rise in gold and silver to an exponential, questionable rise. But why? Adam Ferguson wrote a book called When Money Dies. In it, he showed how the citizens of the Weimar Republic who held physical assets survived, while those who held paper promises saw their wealth evaporate. The majority always learns this lesson too late. We are seeing the karmic reality of everything that has happened since 1971. The debt got too high. The debasement of currencies to monetize that debt went too far. And when you weaponize a currency and an IOU, the collapse accelerates. We are looking at a system where there is no easy solution to saving paper money. Even the world reserve currency is not immune from the sins of fantasy. The fantasy that you can solve a debt crisis with more debt. The fantasy that you can monetize that debt with mouse clicks from nowhere, weaponize it, and then expect the world to keep buying your sandwich for decades, like they did in the 1970s. That game is over, and the gold price isn't the bubble. The dollar is the bubble. But here is where the opportunity lies. Here is the specific data point that proves silver is the most undervalued asset on the planet right now. It is the gold to silver ratio. Currently, the price ratio between gold and silver is 65 to 1. That means it takes 65 ounces of silver to buy 1 ounce of gold in terms of price. But does that reflect reality? Absolutely not. The historical ratio is 15 to 1. Let that sink in. For centuries, the natural ratio was 15 to 1. The market is currently pricing it at 65 to 1. But it gets even crazier when you look at the physical reality. We are entering a phase where physical reality will take over the pricing mechanism. Why? Because every single physical metric shows silver is undervalued relative to gold by factors of 4 to 11, depending on which measurement you use. Let's break down the actual physical ratios. because this is the data the banks ignore. The available above-ground ratio of silver to gold, it is 1 to 1. The LBMA vault ratio, it is 1 to 3. The mining ratio, it is 1 to 8. The COMEX vault ratio, it is 1 to 11. Do you see the discrepancy? The physical supply is incredibly tight. We have a mining ratio of 1 to 8 and an above-ground ratio of 1 to 1. Yet the price is trading as if silver is 65 times less valuable than gold. This spread represents either a permanent revaluation is coming, or it is the largest arbitrage opportunity in the history of commodity markets. So, why is the price of silver sitting at $77? Why isn't it higher? There is a documented track record from analysts calling for $180 silver by year-end. Now, I know what you're thinking. That sounds impossible. But this same analyst called $2,500 gold, and it hit. She called $3,000 gold, and it hit. Now she is predicting a 117% gain in silver despite the volatility. Her track record speaks for itself because her past calls materialized exactly as forecast, while the consensus was wrong. This isn't speculation. This is pattern recognition from someone who has been right on major inflection points. And if you want to verify this yourself, and you should, look at the Commitment of Traders report, the COT report. It shows that managed money positioning on the long side has evaporated. They are positioned now at levels not seen since February 2024. Why is that date important? Because that was when managed money was massively short, right at the beginning of the biggest dollar move higher for silver. Managed money acts as a contrary indicator. When institutions position themselves aggressively in one direction, informed players often take the opposite side because they know crowd psychology creates exploitable extremes. You can check the CFTC COT reports yourself. They are released every Friday. It is free public data. While the paper market plays these games, the physical demand for silver remains incredibly strong, ignoring the recent volatility. Look at the stockpiles. The Shanghai Futures Exchange, SHFE, and the Shanghai Gold Exchange, SGE, stockpiles are down 90% over the last 6 years. They are down roughly 50% just since 2025 alone. Think about that. Half of the visible inventory in the biggest consumer market has vanished in a short time. Ultimately, physical silver demand sets the price, regardless of paper manipulation attempts during temporary windows. And demand is not slowing down. Silver is needed for military applications. It is needed for AI applications. The United States has declared AI a matter of national security. The US has declared silver a critical mineral and is considering stockpiling it according to strategic analysis. This means securing the silver supply is paramount, regardless of the price. When national security implications override market economics, the price ceiling disappears. On the other side of the world, China, the biggest consumer and exporter of silver, has enacted export controls and will tighten them further if domestic production is threatened. So, supply remains tight structurally. Peak silver supply was back in 2016. Roughly 70% of silver comes as a byproduct of other mining, like zinc or lead. This is a crucial detail. Even if the price of silver skyrockets, rising prices won't incentivize a zinc mine to increase production just to get more silver. Silver is the byproduct, not the primary economic target. We have had deficits piling up for 5 consecutive years. The physics of the market are screaming that the price is wrong. Now, I want to talk about the psychology of what is happening, because this is a mental game as much as a financial one. Since 1971, every leader, left or right, has spent well beyond GDP and tax receipts. They created a moral hazard at the Fed, knowing the central bank will mouse-click money to save the system, allows politicians to think they can have deficits without tears. They print with impunity, they debase the currency, and they misreport the actual inflation to the masses, who are being robbed in a great wealth transfer. Charles Mackay wrote, "Extraordinary Popular Delusions and the Madness of Crowds," documenting how group psychology creates bubbles and panics throughout history. But what we are seeing now isn't crowd euphoria in metals. It is the incremental loss of faith in paper money. It is accelerating as more people recognize the system's mathematical impossibility. Gold and silver are rising because currencies are being debased. That means real money and hard assets are going up by definition, not by speculation. But notice how hard it is to invest in them. Precious metals are unlike any other investment you have made. It is like there is a metaphoric red sign hanging above them saying, "Do not invest in these," courtesy of the government. This sign comes in the form of fees and taxes that no other investment bears. It comes in the form of extreme volatility that is largely artificial. It comes in the form of social stigma, as though you are crazy to even consider them. Most people give up somewhere along the way because they are only interested in making more dollars, and frankly, there are easier ways to make more dollars. But only those who realize we are sleepwalking into tyranny and that physical gold and silver are the best tools to preserve liberty will endure. That means paying a premium to get your money out of the system. It means watching with frustration how the official price gets knocked down again and again with no reasonable explanation. It means getting strange looks from your banker or being laughed at by friends and family. But ask yourself, they stopped laughing in 2025, didn't they? Above all, it means having faith in yourself and your decisions after studying carefully. When silver is allowed to find true price discovery based on supply and demand, it will be explosive. The price is currently being managed by fake paper. You should expect shenanigans. Specifically, watch for manipulation windows when the Shanghai market is closed. When Eastern physical buyers disappear temporarily, we historically see coordinated suppression to maximize the downside. But here is the reframe that changes everything about the timing of the monetary reset. We don't know exactly when it happens, but gold at $5,000 is the signpost. It is the warning. The problem isn't that gold is terrifyingly high. The problem is that the dollar and paper money are desperately rotten. Fiat money loses trust, credibility, and purchasing power by a death of 1,000 cuts before the exponential phase begins. Policymakers are caught between impossible choices right now. They have to choose between saving the bond market, which is everything in a debt-based system, or saving the currency. If they save the bond market, they kill the currency. If they save the currency by letting rates rip and the dollar strengthens, they kill trade, exports, and surpluses. Since we live on debt, we are not letting the bond market go, so we choose the lesser of evils. We kill the currency. We misreport inflation. We tell the masses that they are being robbed because of some external bad actor or unforeseeable event to justify whatever narrative comes next. Ray Dalio wrote Principles for Navigating Big Debt Crises, explaining how systems that accumulate too much debt face inevitable deleveraging, either through currency debasement or default. We are watching that play out in slow motion before it accelerates violently. And who is watching this closest? The central bankers. Central bankers are buying gold now. They are loading their guns before combat. They are getting ammunition while they can. I don't like central banks, but you have to watch what they do, not what they say. They are stacking for a reason. That should tell you everything. Gold is cheap. We are early. How do I know we are early? Look at the ETF holdings. Gold physical ETF holdings have yet to reach their 2022 high, despite the price tripling from $1,900 to $5,000. Think about that absurdity. The price has tripled, but almost no one accepts that central banks are the ones participating. Retail and institutions are actually selling ETF shares while the price triples. That is not a speculative mania. That is a fundamental revaluation happening without crowd participation. It is happening under the radar before the masses recognize what is occurring. Retail allocations to gold are still less than 1%. The big money movers are the central banks. When sophisticated institutional money and wealth preservation clients are buying physical while retail is selling paper exposure, that divergence tells you who understands what is actually happening. Wealth preservation clients are not looking to make more money. They are trying to stay rich, not get rich. They know a melting ice cube, even if it is the Swiss franc, the euro, or the dollar, is not the best way to stay rich. They are not speculating anymore. They are saving. They understand that gold and silver are money, not a speculation on price appreciation. You don't sell money, you use money when you need liquidity for a purchase. Preservation is the primary objective. I want to be balanced here. The bearish case matters because reality includes both sides. Gold at 5,000 could pull back violently. Parabolic moves often correct. Silver at 77 hasn't reclaimed resistance, showing technical vulnerability remains. Analyst predictions, like $180 silver by year end, are forecasts, not guarantees, even with a strong track record. Historical ratios reverting to 15 to 1 assume past patterns repeat, which markets don't guarantee ever. Managed money is a contrary indicator, but reversal timing is uncertain even when positioning is at extremes. However, the physical fundamentals are strong. The COMEX has contained delivery pressure repeatedly through decades using contract rollover and cash settlement enforcement. Paper manipulation persisted before, and it can persist again. But here is what the data actually shows, and this is what you need to take away from this video. The gold to silver ratio is 65 versus the historical 15. The physical metrics show a 1 to 11 ratio at the COMEX, a 1 to 8 mining ratio, a 1 to 3 LBMA ratio, and a 1 to 1 available above ground ratio. We have analysts calling for $180. We have managed money positioned exactly where it was before the last massive rally. We have Shanghai stockpiles down 90% in 6 years. We have the US declaring silver a critical mineral for national security. We have China controlling exports. And we have gold at $5,000 while ETF holdings are down, showing that only the central banks are participating. This means we are early. This means the crowd hasn't even arrived yet. Precious metals have that red sign hanging above them: social stigma, taxes, artificial volatility. Only those who see the tyranny coming and understand that metals preserve liberty will endure the premiums and the strange looks. You need to find the inner peace to ride this storm, because when true price discovery is allowed, based on actual supply and demand, it will be explosive. Bottom line, verify everything I just said. Verify the gold-silver ratio versus the physical metrics. Check the analysts' track records. Pull the COT managed money positioning. Confirm the Shanghai stockpile declines. Look at the gold ETF holdings versus the price to see that the crowd is absent. Recognize the symptoms of a sick currency system, not a bubble in the metals themselves. Watch whether physical reality forces a pricing mechanism shift, or if the paper system maintains control for one more cycle. Watch if the crowd participation begins or remains absent, and watch the central bank accumulation. Invest with logic, not hype. If you found value in this breakdown, please check the book recommendations in the description below. Educate yourself before you invest, and do not forget to join the Telegram channel link in the description so we can keep this conversation going no matter what happens to this platform. I'm May, this is what changes, and I will see you in the next one.